Good afternoon, everyone. Extremely sorry for the delay. Are there any more students to come in? Or this is midterm tested figure විතරයි එන අයත් ඇවිල්ලා නැහැ. This is on record mode, right? It's, yeah. Okay, so today we are going to discuss about the aggregate expenditure, demand and supply, right? So this was there in your course outline, but actually we skipped these parts, especially this aggregate demand, aggregate supply, and the ISLM model, and went forward for the government and fiscal policy, inflation, unemployment. Those are supposed to be done at the very end, but I took them forward and with them because those are quite easy concepts. And then I left these two lessons. Filini is to come and teach, but then still she's finding it difficult to leave the baby at home, so I will take up these sessions as well. In future, if she gets a chance, she might come and tell. Okay. Anyway, I think we will have maybe 3 more sessions. I think, right? Do you have a full schedule with you? So I think we have only 3 more sessions. I'm not sure if we have a session next week. The full session. Initial, no? This is general timetable. What is this week 8? Week 7. This is 28, right? So it's week 8. Next week is a holiday. Next week holiday, and then we are meeting the following week. And afterwards, I think for about quite few weeks, you're not going to meet up, right? And then we will have the final session. Is that so? So in that case, next week we will finish the, not today I will do the aggregate expenditure, demand and supply. And whatever we can finish, we will finish. And the next week we will do the ISLM model. And the next week will be a group presentation. Right? Then we'll be done with the syllabus. Okay. Okay, so this is related to, again, macroeconomics, aggregate expenditure, demand and supply. So these are the learning outcomes for this lesson. First of all, you will learn now in microeconomics, we discussed about the equilibrium, right? I hope you remember. So what is the difference between the equilibrium in the microeconomy and the equilibrium in the macroeconomy, you will learn, right? Then you will also discuss the phenomenon of multiplying national income when independent expenditure increases. In this also, with related to this multiplication effect, we have discussed about something called multiplier earlier. I hope you remember. What are the multipliers we discussed? Tax multiplier. And what else? We discussed two types of multipliers. Government spending multiplier. So under which lesson did we discuss that? Which lesson? So that was under the government and fiscal policy lesson, right? So under that lesson, we discussed about the tax multiplier and the government spending multiplier, right? So today we will actually talk about another type of multiplier. And what is aggregate supply and aggregate demand? Identify the factors that cause and change aggregate supply and aggregate demand. Use the ASAD model to explain inflation, unemployment, and economic growth. So let's see whether we have time to cover this latter part. If not, we will cover in the next session. Anyway, this is related to ISLM model as well, right? Okay. First of all, this concept of aggregate demand, aggregate supply, have you touched upon anywhere? Have you learned about it anywhere before? Yes, so no. Those who have learned it before, please raise your hand. Oh, demand and supply. Tell me honestly, have you learned about this? Yes? No? Okay. Okay, so to start off this lesson, actually this concept comes from this thing called Keynesian theory of consumption. So Keynes is one of the economists, philosophical economists, who kind of developed this concept of aggregate demand, aggregate supply. He contributed a lot to macroeconomic theories, right? So from his Keynesian theory of consumption, this concept comes, right? So now there's one main argument which he tells, that is, when an economy's income rises, when a country's income rises, okay, he says that people obviously increase their spending, which is a true fact, right? So people will increase their spending or their expenditure. People will increase when your income rises, right? And another point which he proved is looking at the level of income rise, Okay, so looking at the level of the rise of the income, the increment in the consumption expenditure by people will be lesser than the increment which is happening in the income level, right? The reason for that is if you take an individual consumer, okay, his expenditure or his spending, right? He can spend on either consumption that increased income or he can save that income. Do you agree with that? I think we discussed about this earlier. So part of his income he will consume, part of his income he will save, right? So let's say your income rises by 100. Not all 100 you will spend on consumption. Let's assume you spend 80 rupees on consumption and 20 rupees you save, right? So if you look at this change in income of 100, even though the income rise by 100 rupees, your consumption expenditure rise only by 80 rupees. So you can see always when the income rises by 1 unit, the consumption which is rising, which it will rise definitely, but the amount it will rise will be lesser than the increment in the income. Okay, so that is a second point which is said. Okay, so under the Keynesian theory of consumption, if you want, you can write that down. Under Keynesian theory of consumption, now all of these are there in your textbook. You can read it in detail and get an idea. So I'm just summarizing the content. Keynesian theory of consumption. The assumptions there are first assumption, when income rises, does anybody has a scissor? When income rises, people spending also rise. That is first assumption by Keynes. So all of these assumptions are proved through research, right? That's how you build a theory, okay? So when income rises, people's spending also rises, or people's expenditure also rises. Second assumption is rising consumption expenditure will always be lesser than lesser than the rising income. Okay, so those are the two assumptions of Keynes, right? So using Keynesian theory of consumption, this consumption function is developed, right? So what does the consumption function say? It says that there's a relationship between consumption and income, okay? Income, like consumption is always dependent on the level of income, right? And you can see here they have driven a curve. Okay? In this axis, they have taken the aggregate income, and this axis it has taken aggregate consumption. So earlier we were talking about an individual's consumption and income, right? So what is meant by this aggregate? Now we are in the macroeconomic section, right? So in microeconomics, always our focus is on individual consumers' behavior, individual firms' behavior, right? So there, the two concepts we had was demand and supply, right? So individual consumers' demand and individual suppliers' supply. And wherever it meets, we call it the equilibrium, right? So here our view, or like what we looked at, was much more narrower. We were looking at one market, one industry per se, right? But when it comes to aggregate demand and aggregate supply, it's also demand and supply, but we are looking at the entire economy's demand, entire economy's supply. So all the individual consumers' demand curves will be aggregated together and aggregate demand for the economy will be created. All firms, all suppliers' supply curves will be aggregated together and the supply curve will be created in simple form, right? But when you're deriving it, there are certain other assumptions, certain other ways you will learn about it later. Okay, so in simple terms, aggregate demand means entire economy's demand put together. Aggregate supply means entire economy's supply put together. But when you're putting them together, there are certain practical things what you have to look at, and the way you derive the curves will be little different. Okay, that you will learn eventually. Okay. So that is why when you're developing this consumption function, there's something called aggregate income. That means entire economy's income, right? Not an individual's income. And this axis you have aggregate consumption, right? And as I earlier said, there's a positive relationship between income and consumption. Do you agree with that? When a country's income rises, obviously the expenditure on consumption will rise. When the country's income decreases, the consumption, the amount you will consume, will also decline. Okay, so there's always a positive relationship between consumption and income. That's why you can see a upward sloping curve in the consumption function. Do you agree? Because of the positive relationship between income and the consumption. Okay. And if you take the consumption function, so this is the line which is shown graphically. You can see it doesn't start at the origin. Okay, consumption curve does not start from the origin. It starts somewhere in the middle. Okay, that means this consumption function has an intercept, which is called A. Okay, why does it start somewhere in the middle? Can somebody think about it? Why?
If income is zero, the expenses is zero.
When income, sorry?
When income is zero, our consumption also will be zero.
Now this is consumption axis. Is the consumption zero here?
No.
Income axis, income is zero. But consumption, what's the value? There's a figure here, there's a value. Okay, let's assume it's 100. So there's a certain fixed level of consumption. What does that mean? Whether you earn an income or not, you have a fixed expenditure on consumption. There are people in this country who has no income, but do they stop consuming? Do they stay without consuming anything? They can't. They have to eat, they have to supply their basic needs and wants and to satisfy them. So everybody has a fixed consumption expenditure, whether you earn an income or not, right? So that is what it means. See, the consumption function is a fixed component. This A is your fixed consumption level. Whether you earn an income or not, you have to spend that minimum amount on your consumption for you to survive, for you to satisfy your basic needs and wants. So that is your fixed consumption level. Is that clear? That's why the curve starts somewhere middle. Okay? It denotes that fixed consumption level. Whether you earn income or not, this is the minimum consumption expenditure you have to satisfy. Is that clear? So A is the fixed consumption. You can write that down in this equation, A denotes the fixed consumption level. So this is a simple regression equation, regression model, right? C equals A plus BY. So A is your intercept, and in the consumption function, it's a fixed consumption level, right? What is B? B is a slope, right? Slope of the curve, okay? So which is denoted here. Okay? Now, how does that slope be calculated? This slope, which is B, has been calculated by taking change in consumption for a change in income. Okay? So this B, which is the slope, is the variable component of your consumption function. Okay? For you to basically survive, you need a amount of money to consume. But when you start getting some income, when your income rises, you accordingly you increase your consumption on various things, right? So that is your variable consumption component, right? It varies with your level of income. So A is your fixed consumption. That means probably the amount you spend on food, shelter, and the basic necessities. And whatever extra like income you generate, you might be spending money on other, not necessities, but other activities like, let's say, entertainment or education or any other thing based on your level of income. You might increase your consumption, which are not necessities, right? So B, which is the slope, is a variable consumption. It happens only if you have an income. If your income rises, you will increase your consumption accordingly. That variable component is your slope, which is B. Okay? So you can write down B is your variable consumption. It's not a must to satisfy. It's based on your discretion. You can spend on whatever you like. Okay? So B is a variable consumption component. Okay? And that is calculated by change in consumption expenditure based on change in income. Is that clear? Okay, so this is the curve and that's a formula. And then we come to this concept called marginal propensity to consume, right? So what does that mean? The fraction of a change in income that is consumed or spent. Okay. So marginal propensity to consume in simple terms means when your income increases, how much of a possibility, how much of a propensity you have to spend that increase in income on consumption, right? So income rises by 100, how much of that 100 rise of income you will spend on consumption? Marginal propensity to consume, right? So in this example, your income rises by 100, out of which you have a propensity to spend 80 on your consumption. So MPC is this. 80 divided by 100, which will be 0.8. So your MPC figure will be 0.8. Clear? So in other terms, MPC is same as the slope of your consumption curve. Change in consumption for a change in income. Agree? So MPC is also the slope of your consumption curve. In the consumption function, B, which is the variable component, is your MPC. Clear? So for example, if An MPC of 0.75 means consumption changes by 0.75 of the change in income. If income increases by 1 rupee, your consumption increases by 0.75. That's what MPC means. In other words, the slope of the consumption function is the MPC. Okay? An MPC less than 1 tells us that individuals spend less than 100% of their income rises. So if you get an MPC figure less than 1, that means if your income increases by 100%, less than that only you will spend on your consumption. Usually MPC is less than 1. Okay? So this is how you calculate marginal propensity to consume. It's also equal to the slope of the consumption curve or slope of the consumption function, which is change in C divided by change in Y. Is that clear? Any questions on that? Any questions so far? Then now let's move on to savings function. Now what is savings? Savings is the amount of income which you don't spend on consumption, the balance portion, right? Now here, if your income increases by 100, you spend 80 on consumption, you save 20. So the amount which you don't spend on consumption is called savings, right? Aggregate savings in the economy denoted by S is the difference between aggregate income and aggregate consumption. So from the aggregate income, when you reduce aggregate consumption, you get the aggregate savings. Entire economy is savings, right? So for savings also, we can derive a function, okay, using the consumption function. That is how what I have shown here. Can you just look at this function and see whether you can understand this? Can you understand this? This is the savings function where savings is equal to aggregate income minus aggregate consumption, right? So earlier we derived at a consumption function. Remember? So what is consumption function? A plus by. Okay. So y, let's keep it here. Instead of C, we put the consumption function. Okay. So A is a fixed consumption component, right? So we show it as a constant consumption. A or C dash is a constant consumption, right? So constant consumption plus by, which is a variable consumption part. Okay. So instead of this, we replace the function, substituted the function, right? And here, so if you remove the brackets, it will become y minus constant C minus by. Okay. So we can keep y's together, right? And yeah. So we can keep y's together and bring them together, right? So let's say minus C constant and plus y minus by, right? So we can bring y's together and we can simplify this further, this function, where we take plus 1 out and 1 minus b to the, sorry, we take plus y out and 1 minus b in the brackets, right? So y is common variable to both of these. So we bring y out. So here it becomes 1, here it becomes minus b. Okay, so savings function can be further simplified to this level. Is that clear? So it means savings equal minus constant c plus y within brackets 1 minus b. Okay. So what is this minus consumption means? Why minus constant consumption means? Now earlier consumption function was c constant c plus by. Right? So this is consumption function and this is savings function. Can you see some differences here? Can you interpret those differences? Here, constant consumption was a plus figure. When it comes to savings, the constant consumption figure also comes in with a minus figure. And here also there's a change. Can you explain these two variables? So here you can see in savings also, there's a constant component and there's a variable component, right? Now what is this constant component? Can somebody explain that? Same consumption figure there, the minus of it. What does that mean? So think of your savings curve. Now earlier we drew the consumption curve, right? Earlier we drew the consumption curve and consumption curve started where? Where did it start? In the middle. With a constant figure, it started like this, right? So that this is the intercept. Or in other words, constant consumption. Where does the savings curve start? Where do you think it will start?
Zero.
Not at 0. It starts at a minus level. Here. Not at 0. That's why you can see the savings function. The constant figure is minus. Is that clear? Now, for example, let's say this constant consumption value was 100, okay? Whether you earn income or not, the minimum amount you have to spend on consumption. Let's assume it was 100 here, okay? So your savings function also start at that, but minus 100. Do you agree? Why is that? At this 0 level, you don't earn any income. Okay, if you have no income, out of what do you spend on your consumption? The assumption here is you're spending your savings for your consumption purposes. You have to spend 100 rupees on your food and other essential activities. You don't have any income coming in, so you withdraw money from your savings to spend for your consumption requirements, right? So you're withdrawing your savings. So for that constant amount of consumption, you reduce your savings. That's why at 0 level of income, your savings curve start at a negative level. Okay, so your constant figure in your savings function is minus that constant consumption level. Is that clear? That's why it's called minus C, constant C. Okay. And when your income rises, right? When your income rises, just like a rise in consumption, your savings also will rise. That's why your savings curve is upward sloping, right? But by how much will it rise? Okay, how much will it rise? Now, earlier in the example, you remember that I said 800 is spent on consumption. Sorry, 8 is spent on consumption, so your income, 80 on consumption, and 20 on savings if your income rises by 100. Okay. So if you spend 80 on consumption, 20 on savings. And accordingly, we derive at the MPC as 0.8. So if you spend 0.8 on your consumption, which is your MPC. So I said B, the slope of the consumption curve is your MPC. Remember? So in that case, how did this was arrived? 1 minus that B slope, which is your MPC. 1 minus MPC is how much? 0.2. So that's how it came here. Income, in the savings function, your variable component will be the balance amount which will not be spent on consumption. So if you spend 0.8 on your consumption, 1 minus 0.8, which is 0.2, is the proportion you save out of your increasing income. Is that clear? So that is your slope or the variable component. Is that clear? So your constant saving amount is the minus of your consumption constant figure. And the slope will be the balanced proportion of your income, which you don't consume. That balanced proportion, 0.2, is your savings figure. Is that clear? So that is how you derive the savings function. Anybody who didn't understand that? Please raise your hand. Anyone who didn't understand that? Did you understand how the savings function was derived? Understood? Okay. So what I did was I interpreted these two components, the fixed component of the savings function and the variable component of the savings function. Is that clear? So similar to marginal propensity of consume, MPC, you can also derive at MPS, marginal propensity to save. When your income rises by 1 unit, how much of a propensity is there? What's the proportion in which your savings will rise? That is marginal propensity to save, right? MPS is a fraction of the change in income that is saved. So how do you derive that? There are two ways you can derive it. You can directly calculate it. MPS equals to change in savings divided by change in income, right? MPS or marginal propensity to save will be change in savings divided by change in income. Okay? Or else there's another indirect way you can calculate this. MPS means 1 minus MPC, right? Because what you are not consuming is what you are saving. So 1 minus marginal propensity to consume will give you marginal propensity to save. Is that clear? And here is the curve which shows that relationship. Can you see this? Please take a close look at this. First of all, look at this table. Okay. So this shows the aggregate income levels. And at each level, what is the aggregate consumption savings? So Y will be equal to C plus S, right? Okay. So your aggregate income is denoted here. This is the consumption you have at each level. And as a result, these are the savings you have at each level. So can you tell me what is the constant consumption level by looking at the table? What is the constant consumption of this economy or fixed consumption? Whether you earn income or not, what's the fixed consumption level in this economy? What is it? 100, right? Why? At your zero level of income, you have 100 amount of aggregate consumption. That is your fixed consumption in this economy. Okay. So their consumption curve, which is denoted by the blue line here, should start at 100. Agree? And then it shows a positive slope. Slope of it will be the MPC. You remember that. Okay. And using the same curve, they have drawn a savings curve as well. Can you see that savings curve here? Now, at zero level of income, what is the saving? At zero level of income, what is the saving? Minus 100. Zero level of income, aggregate saving is minus 100. So there was plus 100 consumption. To satisfy that, you had to withdraw money from your savings. So at zero level of income, your savings is minus 100, right? And from this point onwards, you can see income is rising. As a result, your consumption curve is also rising. So when your income starts rising, your savings also have started rising. Can you see that? That is why savings curve is also showing a positive direction, right? And can you see it started minus 100, but the negative effect is reducing slowly. And what at one point savings becomes zero, and thereafter only you will start seeing positive savings, right? So below zero level, whatever you have here is dis-savings or negative savings, we call it, or dis-savings. After you reach this zero level, only you can see positive savings or savings, right? These are dis savings and this is savings. Clear? Okay, now how do you derive at the equilibrium in a macroeconomic level, right? So earlier we have discussed how to derive the equilibrium in a normal microeconomic situation. What is the equilibrium in a microeconomic situation? Demand, where the demand curve equals supply, is the equilibrium in microeconomy, right? In macroeconomy, how you derive at the equilibrium is different. Okay. So how do you derive at that? Okay. So take this graph into consideration, right? The first step you do is, okay, so this is your income curve, income axis, aggregate income, and this is your consumption axis, right? First of all, what you do is you draw a line, right? From the origin, a positive sloped line, which has a 45% degree. Okay, at 45% degree level, you draw a line starting from the the origin. Okay, so that is your we call it baseline or line to which we refer. So at this 45-degree line, when you draw a 45-degree line here, do you agree at any point in this 45-degree level, okay, if you mark, let's say, any point A or B or C, at any point, your income will be equal to your consumption. Do you agree to that? When this whole graph is divided to two parts from the right middle, හරි මැද්දෙන් දෙකට බෙදුවම 45 degree line එකක් ඇඳලා මේකේ මේ පැත්ත සමානයි මේ පැත්ත. That means at any point, point A or point B, whatever the figure you get, so Y1 here and C1 is equal to each other. C1 equals Y1. Here Y2 equals C2. C2 equals Y2. At any point here, මේ පැත්තේ තියෙන figure එකයි මේ පැත්තේ තියෙන figure එකයි equal to each other. So that's why we call it, it's a baseline or the reference line, right? So in an economy, if your figure falls anywhere in this baseline, where your consumption equals income, that means the economy is at equilibrium. Agree? Right? We learned that income equals consumption is equilibrium. එකක් ඉගෙන ගත්ත macroeconomic පටන් ගන්නදිම in a basic economy, consumption expenditure should be equal to income. That is where the macroeconomic equilibrium is. So how you show it graphically is like this. So you draw a 45-degree line. Any point in it will be equal to each other. Consumption equals to income. Clear? So if you look at this graph, they have also drawn that 45-degree line. Can you see that in the black line? So that is 45-degree line. So any point in that line will represent an equilibrium in the economy, where consumption equals income, right? And also they have drawn the consumption curve separately. Okay? So will you agree with me if I say, where this consumption curve line and the 45-degree line intersect with each other, that is this point, okay, is the situation where that economy's consumption equals income. Agree? Okay. So in that case, that point where this consumption curve and the 45-degree line intersect with each other is the equilibrium of this macroeconomic situation. Agree? Clear? Okay. And that point, what is that point? At that point, income is equal to how much? 400. And your consumption is equal to 400. So of that consumption function, if you look at the savings function also, can you see that at 400 level of income, in your savings curve, savings value becomes 0. Can you see that? So where your income is entirely consumed or is equal to consumption, does that mean there's any saving? No saving. P plus S not S එකක් නැහැ. Entirely you have consumed all what you have earned. So Y equals C means there's no saving. Saving becomes 0. That's why at the equilibrium level, savings function, savings will take a 0 figure. Is that clear? Okay. So that is denoted by the savings curve as well. And here also in this table, you can see the same situation. Aggregate income, where aggregate income is 400, aggregate consumption is also 400. 400 equals 400, that means it's equilibrium, right? And at that point, savings is 0. That means equilibrium. So, do you now agree at the equilibrium level, income is equal to consumption and there's no savings in the economy. Is that clear? Savings are zero. Okay, so that is the equilibrium in the simplest form in a macroeconomic situation. Agree? Did everyone understand? If anybody who don't understand, please raise your hand. Otherwise, whatever the future developments we learn out of this are based on this. And if you don't understand the basic concept, you will find it very difficult to understand the future concepts. Clear? That's why I'm going very slow. And if anybody don't understand, please tell me now itself. Did everyone understand? Those who are at the back? Neither. Neither. Pidipaskaniga denna. අනැගිටින් දෙන්නම නැගිටලා ඉස්සරහට. Get up, stand up. Oh, yes, you and you, both of you, come forward. The other one, did you hear me? Oh, I missed it. Anyone else falling asleep? Okay. Did you understand this? Come forward and teach the class. Now, I don't have time, otherwise I would explain it further. What's the time now? Yeah, so you have to go fast. But at the end, you have to explain it to me before you go out of the class. Huh? Okay. So at the equilibrium level, tell me the two conditions. At the macro equilibrium level, macroeconomic equilibrium level, what are the two conditions? Both of you, what is the two what are the two conditions?
The income will be equal to the consumption. Say, capacity.
You have been away. You-
They will always less than income.
That's why.
Equity.
Where I said rising income should be, rising consumption should be more than rising income. That's why you have to honestly. And after that, no notes. Nothing in the mind also. Okay, so at the equilibrium level, consumption expenditure equals income. At that point, savings are zero. Okay, now why it is you have to figure out. I explained it to the class. Okay, the other thing is that there's another observation which you can see. There's another observation. Okay, now stop laughing. Okay, so there's another observation which you can see looking at these two graphs, right? That is, you can see that now this is the equilibrium level where income is equal to consumption, 400, 400. Before the equilibrium level, that is this range, okay, where your consumption curve is above the 45-degree line. Consumption curve is above the 45-degree line. Can you see that? At that point, you can see you are having negative savings or dis-savings. Consumption is above the 45-degree line means you have negative savings or dis-savings. It's below the zero level of your savings curve. Right? Negative figures. It can be seen here as well. Before the equilibrium, now this 400 level is the equilibrium. Before the equilibrium, you're having negative savings. Clear? But these negative savings are improving, right? It started at minus 100. But since your income is slowly rising, you are slowly recovering your negative saving situation. So it becomes minus 100, minus 80, minus 75, minus 50, and it becomes 0. So you are kind of, restoring your savings, which you consumed earlier. You are kind of now, recovering your negative savings. Clear? And once it comes to the equilibrium, your consumption becomes equal to the income. So your savings become 0, right? And beyond the equilibrium, you can see the consumption curve, blue line, lies below the 45-degree line. That means you're creating savings. Your savings are increasing. Okay, so you can see that means in your savings function, you're going beyond the 0 level and you're creating positive savings. Is that clear? So positive savings means it's going beyond 0, that it becomes plus 50, 100, 150. Clear? Okay. So those are other two observations. Quickly write them down. Now that is not there in your note. Do you want me to read a note? Okay, like in a summary form, okay. Refer to this graph. Okay. How to find the equilibrium level graphically? How to find, you can say, macroeconomic equilibrium level graphically. In the consumption curve graph, draw a 45-degree line. Draw a 45-degree line from the equilibrium. From the origin. Draw a 45-degree line from the origin. That's the first step. Okay. Second step, everywhere along this line or at every point along this line, aggregate consumption equals aggregate income. Aggregate consumption equals aggregate income. Therefore, savings will be 0. Okay. Third step, where the consumption curve is above 45-degree line, where the consumption curve is above the 45-degree line, consumption exceeds income, thus savings are negative. Next point, where the consumption curve is below the 45-degree line, where the consumption curve is below the 45-degree line, consumption is less than income, therefore savings will be positive. Next point, where the consumption line crosses the 45-degree line, consumption equals income. Okay, so this is an explanation for slide 7. So you can write slide 7. When you are referring your note. Okay. So I'll give you a 5 minutes break, 5 to 10 minutes break. Don't take too much. Please go wash your faces and come, those who are feeling sleepy. Ikmanata. Those who are feeling sleepy, please go wash your face and come. You have to concentrate in this, even though we have this at the very end of the lecture day. I know that, but it's very important. Take about 5 minutes. On net, then how the Nidhi Mata? After both of the time, I'll have to check. Right? AC. I'll put it in. We lay the whole water.
Government subsidy මොනවද involved වීමක් තියෙනවද මේ savings එකට විතර? මේ theory එකේ government subsidy වල මොනවද involved වීමක්?
මොකටද?
මේ theory එක දැන් negative යන්නේ අපිට government subsidy එකක් කියනවා නම් negative එක අඩු වෙනවනේ. saving එකෙන් ගන්න ගාන අඩු වෙනවා. so consumption එක 100 නම් at the point of
Subsidy කියන්නේ කොහොමද?
samurthi, like if the government is contributing 50% of the feed consumption, the minimum consumption, is there an involvement in this theory, in this point?
Yeah, it will come. Now, this is the basic level look. So we are only looking at the households and income. But that will come. But no economy, the government will provide subsidies for consumption. That's the issue.
Okay.
Yes. Group assignment. For the group assignment, you have to form groups, right? Do you already have groups? How many members? 5 or 6 or 5? Okay. Do you have a list of your group members already? Okay, now who's the representative, you know, and there's someone else, no? Can you two get together and collect names and the registration numbers of each group, right? And create one Google form document for me, like create a Google form where they can fill in their information form, right? and combine them together, and can you send me the group list? Does your group has a name or something? How do I recognize which group is what? Either way, if you like to have a name for the group, you can have a name, then member, and the registration number, or else you can name it as 1, 2, 3, 4, 5. But you also know which group is you, right? And create a group list, name list, and send it to me. Okay? Your group assignment, I will upload by tomorrow, right? So you have to do it, and there will be a report on the same content, same topic. You have to do a report, and you have to do a presentation, right? So report, I will require you to submit it before the presentation, right? So the presentation will fall on the final date of your lecture. Can you check your schedule? What is the final date of your lecture? Twenty-fifth February. So on the 25th February, you will have the presentation. So I might set up the date as 24th February again, you have to upload the report. Right? Same content on the report, you have to do the presentation. So presentation criteria and the report criteria, everything I will upload. Well understood. Okay. So that will be out of macroeconomic concepts like inflation, unemployment, practical application. Okay. So practically, you have to search information from the CBSL, Central Bank report, and Census and Statistics, and also analyze the current economic environment context and how these things play. So that question will be given to you. So you have to do a very practical, like whatever you learned here under macroeconomic concepts, you have to practically apply to the current situation. I think it will be interesting. Plus, it's easier to do it now because everything is demonstrated in the current economic context. Okay, so you can refer to news and any other articles or research publications and do it. I want to do a proper thorough study. So send me the group list. Send me the group list by tomorrow. Can you? How many groups are there altogether then? More than 10. How many students are here in the class? In the virtual. 66. No. In that case, I don't think within 2 hours we can do the presentation. There are 10 or more than 10 groups. Presentation, let's say for 10 minutes or not. Then what can we do? Is there another day we can arrange the presentations for? When is the final date for your, I mean the course? Course ends on when? That is with exams and everything, no? When is exam? April. Mm. Before the 14th of March, we had to finish everything, assignments. So in that case, so in future after this, do you like entire Saturday and Sunday is full for you or? Now, anyway, that 2 hours will not be enough for the presentation. So you all discuss and see what you could do. One thing is, if they allow, I can stay even after 5:30, 3:30 to 5:30. And I pass it in the lab, we can finish off the presentations, right? That is one option. Or else to have it on another day. Can you all discuss among you all and tell me which is you prefer? Okay, we'll do like that. That will be at the final end week of the like the series. Yes, updating the set. No, එහෙම එකින් එක release කරන්නේ නැහැ. Everything, I don't know how, what is their policy. Do they release assignment marks to you? Huh? Not yet, no? Anyway, we have to finalize all CA marks by the 14th of March. And I'm not sure whether they publish it to you. I don't know, just check with them. Huh? So we have to send them by 14th March. From me. I can't give it, it's confidential. So just check with them whether they publish it to you. That will be anyway after March 14th or 15th. I don't know where they publish. What about other lectures? Huh? Did they also give you the marks? Don't lie. Huh? I think that will be confidential. Okay, so this is where we start. Are you fresh now? Is everyone back? Determination of equilibrium output. Okay, so now we learned the basic concepts of consumption, savings, and using consumption and savings function. How do you derive at equilibrium in a macroeconomic situation, right? So equilibrium occurs when there's no tendency for change. Equilibrium means the economy has come to a balanced state, and you have come to a point where you are in a balanced situation. Okay, you have settled down. That means there's no chance for any change to happen, right? Even in macroeconomics, equilibrium means that, right? The economy is defined to be in equilibrium when aggregate output, or in other words, aggregate income, is equal to planned aggregate expenditure, right? Planned aggregate expenditure is the total amount the economy plans to spend in a given period, right? So aggregate expenditure, where income is equal to aggregate expenditure, is your equilibrium, right? Now earlier, as aggregate expenditure, the only component of expenditure we took was consumption. Do you agree? Because that's the simplest form in which I can explain it to you, right? Because that's the starting point of expenditure. But remember, we learned under macroeconomic, like the initial lessons, that there are many sectors in an economy, right? So there's individuals, households who create consumption, and there's who are the other players in an economy? So consumer or households is the first player in the economy. Who else? Then comes firms, right? So households and firms together, that economic situation, what did we call it? What did we call it? The people who always came to lectures and asking constantly without having a class. What is that economy called? What is that? There are households and firms. What is that economy called? Two-step economy. Okay, did you at least go through my like the lecture recordings? No, good luck. Okay, so two-step economy is a situation where you have, it's a basic level of the economic classification. Remember, where households and firms are there, right? So I initially told all these concepts initially using only consumption, but usually an economy cannot survive. I mean, they can't survive just with consumers. Households විතරක් ඉන්න economy එකක් නෑනේ. අනිවාර්යෙන් simplest economy එකක් households and firms should be there because households have needs and wants. For them to satisfy their needs and wants, there should be somebody who produce goods and services and give them. So that will be the firms. So it's a must. There should be at least two sectors in an economy. So that's the simplest level of economy. Two-sector economy. That's how you start, right? So in a two-sector economy, you have households and firms, both. So both of them will contribute to this aggregate expenditure. Okay. How do the consumers contribute to aggregate expenditure? What do they do? What do they spend on?
Right.
They spend on consumption, right? And what do firms spend on? Firms expenditure, firm spending was denoted as what? Remember? Investment, right? Firm spending was denoted as investment. They spend on investment. They spend on capital goods and, doing the business, which is an investment for them, right? So in a two-sector, which is the basic level of economy, the aggregate income, the income of the country economy, is equal to consumption expenditure by households and investment expenditure by firms. C plus I. Remember we learned this, right? This equation, y equals C plus I, right? So that is what they have derived here. Okay. So hence equilibrium can also be written as y equals C plus I. Clear? Okay. So when the economy is in disequilibrium, right? Disequilibrium means it's not equal, right? You can see aggregate output or aggregate income is higher than planned aggregate expenditure. Okay. Another concept which we learned in the very first lesson, probably in macroeconomy, do you remember that there are three approaches to calculate the national income? What are three approaches? Production approach, income approach, and expenditure approach. And there, I said that when the economy is in equilibrium, its income is equal to what? Expenditure, yes, expenditure. And that is also equal to production of the country. Agree? Income is equal to expenditure is equal to production. And there I said gross domestic income is equals to gross domestic expenditure, which is equal to gross domestic production. Remember? Okay. So in an economy where there's an equilibrium, whatever the production which is done in the country, total product or output in the country, which is created by the country, is the amount which you have spent on producing those goods and services. So that will be equal to the expenditure and is equal to the income what you can generate out of those products by the entire country. That's why your income is equal to expenditure equal to production. Agree? Right? That is why you see that These word aggregate output, aggregate expenditure, aggregate income, or interchangeably being used. So don't get confused, right? That means that this is the reason for that, right? So here aggregate output means aggregate income. Agree? Okay. So in a situation where the economy is in disequilibrium, that means your aggregate output, or in other words, aggregate income, is higher than the aggregate expenditure. So economy has come to a disequilibrium situation, right? So in such a situation, you can see that firms plan to sell more of their goods than they sold, and the difference shows up as an unplanned increase in inventory. So when you are in a disequilibrium situation, you have a higher income, right, than what you have spent on your consumption and investment, right? So that means you can see that you have generated more income, or more output has been created in the economy. More output has been created in the economy than what is being consumed and what is being invested upon, right? So in other words, the businesses have created more production in the economy, they have created more output, but consumers have not purchased those entire output. So consumption is lesser. Other businesses have not bought your products also. The investment are also lesser, right? So you know that when you produce goods and services, you sell it either in B2C market or B2B market. So nobody has purchased your product. I mean, more like you have produced more, but lesser has been purchased by the economy. That means you have created extra stock, inventory we call, right? So you are creating inventory. You are, sticking your money in inventory, which is not being circulated. Clear? So you're in this equilibrium situation. The other side, which can happen to the same situation, is where you have created the economy's expenditure being higher than the products which the firms generate in a particular year. So you produce a certain amount of goods, but people in that year consume more, or businesses buy more products. Your consumption and investment is higher in the economy than the production that you create. So that means the firms have, they have lesser output and more demand for the products are there in the market. That means you are using up your inventory. You might have some inventory or a buffer stock. You're using products out of that inventory or the buffer stock, right? So economy is not in equilibrium situation, right? Because in both situations, output either is higher than the expenditure, output is lesser than the expenditure. Clear? Okay. So I just explained what will happen in a disequilibrium situation. Okay. And now this macroeconomic equilibrium. Now earlier I showed you a graphical demonstration, right? The basic level of graphical demonstration. Actually, deriving at the macroeconomic equilibrium using this income equals aggregate expenditure approach is called income expenditure approach. So that is one way in which you can derive the macroeconomic equilibrium, income expenditure approach. Okay. There's another approach which we will discuss later. So for the moment, though, this is income expenditure approach. Okay? So the same thing what we discussed earlier is also shown here. Take a close look at these two graphs. The only change which comes here is that earlier we looked at the basic level where we only took the consumption function. Remember? But we know in a basic level of economy, at least there are two sectors, households and firms. So households create impact on the consumption, but there's also firms. Firms also spend their money in terms of investment. So I part, investment part also should come into play in when you're deriving your functions. Clear? So, usually investment is considered as a autonomous function. What does that mean? It doesn't depend on the level of income. Business organizations, firms don't decide how much they invest based on the country's income. No? Consumption households decide on based on the income you generate. But investment independently decided. So it's the autonomous figure or it's a fixed figure which the country's firms will decide, right? So investment will always be a fixed figure. So can you see that in this line, I or investment is denoted by a very it's a constant line, okay, because it's fixed. Okay, here the assumption is the investment is 25. Okay. So that blue line is a consumption curve. Okay. Now, if you are deriving at the aggregate in expenditure curve, you have to add your investment to your consumption. So you had a consumption curve earlier. Now you add the investment part also to it, which is plus 25 in this example, and you derive at the aggregate expenditure. Agree? Right? So what are your consumption functions? So C plus BY එකට 25 add කරලා තමයි aggregate expenditure curve එක derive කරන්නේ. Clear? So you can see to that blue color line, which is your consumption function. Here the figures they have given is 100 plus 0.75y. You have added 25. So that curve has shifted up, shifted leftwards by a constant figure. Can you see it's a parallel shift? Because it has shifted by 25. So parallelly, the curve has shifted upwards. So you can see that red color line which is denoted here is your aggregate expenditure curve. Is that clear? And can you see that aggregate expenditure curve starts from where? 125. Why? Because your constant consumption, autonomous consumption figure was 100 and constant investment figure is 25. So 100 plus 25 is 125. So the intercept of that curve will be 125. It starts at 125 plus by, the slope of the consumption curve into y. Clear? So that is how it goes. Okay. And also, yeah, any questions?
When income is zero, then we, how can we, investment?
When income is, no, investment is also, I said it's an autonomous figure. It doesn't depend on the level of income in the economy. So it's a must, it's a compulsory investment. Whether you have zero income or 100 income or 500 income, firms will spend 25 on investment. It's autonomous. It doesn't depend on consumption. Like the constant consumption figure. Agree? So you can see it's demonstrated here in the table as well. You have aggregate income, right? Then aggregate consumption, then planned investment. So consumption plus investment will determine aggregate expenditure. Clear? And also they have denoted here at each level whether the economy is in equilibrium, right? So what is the point where the economy comes to equilibrium? Where the income, aggregate income equals aggregate expenditure. So you have to find it on the table where aggregate income equals aggregate expenditure. So here you can see that aggregate income is 500, aggregate expenditure is also 500. 475 plus 25, right? So at that point, the equilibrium you have derived at the equilibrium. Is that clear? And using that curve, so here it's demonstrated graphically. Okay, this is the 45-degree line, and this is your aggregate expenditure curve, where the aggregate expenditure curve intersects the 45-degree line. This point is considered the equilibrium. Clear? Same scenario as before, where it's 500, 500 on both sides. Okay? Is that clear? Any questions? Yeah. So the same thing, right? So this is graphically demonstrated, right? Same thing. The macroeconomic equilibrium you can derive using the formula as well. Okay, so that was graphically demonstrated how to derive equilibrium graphically by, using this tabular information. You can plot it down on the graph and graphically derive. So for your exam, these are possible questions. I could give you this sort of a table and keep some, columns blank for you to calculate and put the figures, draw it graphically. Graphically draw the curves and find equilibrium. That is possible, right? So you have to go through them clearly. You read the textbook which I have uploaded. There the chapter is aggregate expenditure, demand and supply. So read it thoroughly. You will get a deeper understanding, right? So these are possible questions I can give. Okay. Also, you can derive the equilibrium using the formula method. Okay. Now take a close look at this formula and see whether you understand it. See whether you understand this formula. So that is also a possible question. I could give you some figures and ask you to derive the equilibrium using the formula. Okay. So in this simple economy, right, where there are two sectors, income equals consumption plus investment, right? And how do you derive the equilibrium level? So what you have to do? Now for consumption, there is a function, right? So you can substitute the consumption function instead of C and substitute the investment value. So it will always be given as autonomous figure. Instead of I, you can substitute that value, right? So in this example, consumption function is 100 plus 0.751, right? And your investment figure is 25, right? Okay. So when you saw this 100 plus 25 is 125, and your variable figure is 0.755. Okay. So y equals this. Now you have to solve the y. Simple mathematics, right? So this part you can bring to this side, y minus 0.75, y equals 125. So this will become 0.25y equals 125. So y means 125 divided by 0.25, right? So that will come to how much? 500. Right? Y becomes 500. So income becomes 500. That is where the equilibrium is. Clear? So you derive the same figure as graphically. Okay? That's a possible question. So මේ වගේ information ටිකක් දීලා මේවා fill කරන්න ඔයගලන්ට දෙනවා. Right? දීලා මේ විදිහට graphically demonstrate කරන්න කියනවා. So you graphically demonstrate that. Also, you derive the value through formula method. So sometimes I might give you the consumption function and ask you to fill out the consumption figure as well. Possible to do that with function එක දුන්නා income එක apply කළා consumption එක හොයා. Possible no? Yes or no? Yes. So fill the table, draw the graph, and also calculate the formula. Okay, so that is income and expenditure approach. Remember that. That is income and expenditure approach. Okay. So that is one way of deriving your equilibrium. There's another approach, second approach to derive the macroeconomic equilibrium, and that is called savings or investment approach. Right? Now, do you remember when in our initial lessons of macroeconomics, I said, circular flow of economy, do you remember? Circular flow of income or circular flow of economy, where there are, in a basic economy, you have households, two-sector economy, you have firms, right? And there's a circular flow of goods and services and circular flow of income. Remember? So households give them factors of production and firms give factor payments, right? Then firms give goods and services to households and households give prices for these goods and services. Agree? Okay. And I said in any economy you have the bank. Okay, in even a two-sector economy you have a bank. And when bank is there, total income households receive, they don't spend on consumption, but part of them they will save. Remember? Banks will use those savings and provide investments to firms. Remember that? So in this circular flow diagram, what did we consider savings as? There was a specific term we call it leakage. Savings means money is leaking out of the circular flow of economy, right? So we call it leakage, or there's another term we call it leakage, or there's another word for the same thing. Withdrawal. Remember? Savings or withdrawal, both are same, right? And investments in a circular flow of economy, what did we call them as? Injection. Okay. So savings is a withdrawal or a leakage out of the circular flow, and that will be injected back to the circular flow as investments, right? So now income and expenditure approach, macroeconomic economic equilibrium means income equals expenditure. But if you are looking at the same thing from the savings and investment approach, right? What it says is when an economy is in equilibrium, your leakages or withdrawals, let's say leakages or withdrawals, are equals to your injections. Do you agree with that? Okay. Whatever which goes out of the economy as savings should come back to the economy in the same amount for the economy to be restored in equilibrium. Then the වැඩිපුර leak වුණොත්, inject නොවුණොත් ඒ ප්‍රමාණය economy becomes disequilibrium. Right? So if there are 20 amount of savings which goes out of the economy, 20 should come back to the economy as investments. Agree? Right? So in that case, we say economy is at equilibrium where another way of looking at it, indirectly looking at the economic equilibrium, where your savings are equal to investments. S equals I. කලින් බැලුවේ aggregate income equals aggregate expenditure. The may approach එකෙන් බලන්නේ injection withdrawal weave එකෙන්. Where savings are equals to injection. So that way also you can find equilibrium in the economy. Okay. So that is what has been drawn here. So you can see they have drawn the savings function, savings curve. Remember in the same example, it started at a minus figure, then it increases, right? And they have drawn the investment curve, where savings curve intersect the investment curve, that is the equilibrium. Clear? Okay. Now the initial example which I used savings curve, අපි මේ zero happen කරන්නේ equilibrium විදියට ගත්තේ, but now you can't take it because it's not only C we are looking at, we have an investment component as a C plus I in it. Is the I curve එකෙන් තමයි දැන් බලන්නේ. The I intersect the savings curve. That is your equilibrium. So it comes at 500. Okay. So that's the same value you derived here as well. 500. Same economic approach apply කරලා A equilibrium එක හොයාගන්න. Is that clear? Any questions on that? Is that clear? Any questions? Now we have to look at this multiplier effect, right? Now, what is the multiplier? So I have touched upon multiplier earlier. I hope you know what is the multiplier. So quickly read this definition which is given here. What is a multiplier? Multiplier is the ratio of the change in the equilibrium level of output to a change in some exogenous variable. Now, what is this exogenous variable? A variable that is assumed not to depend on the state of the economy. That is, it does not change when the economy changes. Now, exogenous variables means a variable which does not change based on a change of the economy. Economic change means based on a change of, let's say, example, income. Due to a change in income, these variables do not change, right? So, for example, investment earlier we discussed, we said it's an autonomous variable, or in other words, exogenous variable. Investment does not depend on any change in income. Your income of the country might rise, but firms don't change the investment. They decide it independently. It does not depend on income. But if you take consumption, is it exogenous variable?
No.
No, because it depends on the income. Savings? No. Savings also you decide based on your income, right? Based on the income you generate, You decide savings, right? You decide consumption. But investment does not depend on income. Like taxation, we earn the tax multiplier. That doesn't depend on income. Government spending does not decide on income. That's why they are constant variable. But later on, I don't think we will be able to cover. If you take taxation, that there's a certain portion of taxation which depends on the income, right? There's a function for tax also, but we learn tax as a autonomous figure, right? For easier purpose. Where we learn about the tax multiplier. Remember? And this government spending multiplier also we call government spending is a fixed component. Even now, if you take savings as a function, there is a constant saving figure. But we take savings as a factor which depends on the level of income. Consumption also gets a constant figure, but we generally consider consumption depends on the income. As a overall, if you look at the figure, the calculation based on is on the income, right? So autonomous variables are things like investment, government spending, taxation, exports, imports. So those are autonomous components. Clear? So in that case, so here example, a simple example has been taken, which is investment. Assume that planned investment increases from its current level of 25 to 50. So earlier in the example, we took the investment as 25. So assume investment increases from 25 to 50. That means there's a change in investment of how much? By 25, your investment has increased. So what do you expect to happen to the economy? So in an equilibrium economic situation, income is equal to C plus I. If your I increases by 25, what do you expect to happen? When I increases by 25, you expect Y to increase by how much? 25. That is a normal assumption, right? So I increase by 25, Y also increase by 25, right? But what will happen? When your income rise by 25, what will happen to consumption? When the income of the economy increases, what will households do? They will also increase the consumption. By how much? By 25? No, how much? Based on its MPC figure, right? Marginal propensity to consume. So let's say it's 0.75 MCP. It's going to make 25 into MPCA figure, I think. Consumption will increase, right? So consumption increase. එතකොට equation එකේ මේ factor තවත් වැඩි වෙනවා. Agreed? එතකොට consumption එකේ මේ factor තවත් වැඩි වුණාම ආයෙ මොකද වෙන්නේ y එකට? Y එක තවත් වැඩි වෙනවා. Then what will happen again? Y තවත් වැඩි වුණාම what will happen? Again your C will increase. මේ y එකේ වැඩි වෙච්ච ප්‍රමාණය අපි හිතමු x කියලා x into 0.75 වලින් තවත් consumption වැඩි වෙනවා. Right? So consumption වැඩි වුණාම ආයෙමත් මේ පැත්ත තවත් වැඩි වෙනවා. Right? Then what will happen to income? It will again rise. Can you see when there's a small change of investment here, which is exogenous variable, there are multiple effects on the level of income in the economy. There's a multiply effect. That is what you call by multiplier. Okay. So when an exogenous variable increases, your entire economy has multiple impacts of it. That's what we discussed on the government revenue as well. When government spending increases, it has multiple effects on the economy. So similarly, investment increases, it has multiple effects on the economy. That's what it means here. Aggregate income rises, consumption spending by consumers rises, savings rises. It will create multiple effects on the economy. Clear? So therefore, we can't say when the investment rises by 25, the impact on the economy is only a 25 rupee increment, but it will be much more than that, right? So how do you identify how much when your investment rises by 25, by how much will the entire economies will expand? How do you determine that? To decide that, we use this concept called multiplier. Clear? So how do you calculate the multiplier? Okay. Now this is how you calculate the multiplier. So here you can see at the end, they have derived at the multiplier. Okay. So at the equilibrium, we know savings are equals to investments, right? So you're looking at that. You can recall the marginal propensity to save, MPS, right? Is the fraction of a change in income that is saved. It is defined as a change in savings or a change in income. So you remember that now, how we calculate MPS? Change in saving divided by change in Y, right? Because change in savings must be equal to change in investment. Change in investment. For equilibrium to be restored, we can substitute change in investment for change in savings. Clear? So based on the injection versus withdrawal approach, right, savings are always equal to investments. That's a situation when the economy is at equilibrium. So in that situation, where S equals I, we can replace this MPS formula saying change in savings should be change in investments. S to I gone, S equals I at the equilibrium, right? Divide by Y, right? So when you solve that, right, what that means, so here we are assuming change in investment is equal to change in savings, right? So your NPS will be replaced by change in savings and not a change in investment data, change in Y over change in Y, right? So now you want to recognize when your investment change by a certain percentage, how much your income will change now, right? So you know change in income, you know. Sorry, change in investment, you know, right? Then how do you identify this equation? So you can solve this equation. Okay. MPS figure you can bring to this side as 1 divided by MPS mathematically, right? And this Y component we can bring to this side as change in Y. Okay. So change in income, change in investment into 1 divided by MPS. This formula I just made at the mark, right? So now you know change in investment figure, right? How much is that? 25 into 1 divided by MPS will be equal to your change in income. Clear? So now you want to know when your investment changed by 25, by how much your income in the economy changed. So changing investment into 1 divided by MPS. So this 1 divided by MPS figure is your multiplier. This is how you derive your multiplier. Changing investment into the multiplier will give you the entire impact on the income, right? So what is the multiplier? Now, earlier, do you remember that example? What is the NPS figure? Sorry? 1 minus MPC. What was the MPC figure earlier? 0.75. Do you remember that? So 1 minus 0.75 is how much? 0.25. So MPS is 0.25. So 1 divided by 0.25 into 25 will give you change in income. Can you quickly calculate that and tell me? $100. So change in income is how much? 100. So what does that mean? When your investment changed by 25, that into the multiplier. So මෙතන 1 divided by 0.25 can multiply cannot 4 here. Multiply is 4. So 25 into 4 is how much? 100. Right? So change in income due to a change in investment is 100. So investment 25 වලින් වැඩි වෙද්දී entire economic අර multiple rounds ගිහිල්ලා entire economic expand වෙනවා 100 වලින්. Okay, so there's a multiplication of 4 times. The multiply is 4. Is that clear? Right? So that is how you calculate. So අර වගේ question එකට අන්තිමට ඔය වගේ multiplier පොත් දීලා calculate කළා what is the change in the income කියලා අහන්නත් පුළුවන් in your question. Is that clear? Okay. So aggregate demand and supply is another part. I don't think we have time today, right? If you like to stay, we can continue. What do you like to do? Ah? I can't hear. Okay, so now it's I think for 5:43. I took a little bit of extra time because I got late to start the lecture today. So I took extra time. Really sorry about that. So this aggregate demand and supply will be connected to ISLM as well. So modern මේ කොටසක් කරලා ඒකත් එක්කම ISLM එක කරලා we'll try to finish it next week somehow. If we fail to finish it, we might anyway have to schedule the group presentations to another day. ඊළඟ වෙන දවසක් මේක complete කරන්න තියාගන්න. හරිද? So do you think the pace at which I went today was slow, or is it okay for me to fast track it? That's what I wanted to know, whether you had touched these concepts earlier. එහෙමනම් I can go fast, skipping certain parts. Now, for example, consumption function, savings function, have you learned them before? Next. Okay, let's see how we can cover things because ISLM is again little further complicated. So that's fine. Let's see. Okay, then I'll see you next week. The group assignment I will upload on LMS. Please start working on it, right? Please send me your group name list as soon as possible. Students are joining on the Teams. Do you have any questions? Did you understand today's lesson?
Yes.
You understood?
Yes, ma'am, it was clear.
Okay. Then thank you very much for joining in. If you have any questions or any area which you didn't understand, please email me so that we can discuss. Okay, then I will upload the group assignment tomorrow. And you will be given sufficient time to work on it. And you have to produce a report from it. And there will also be a presentation. So I'm hoping to schedule the presentation for the final week of the lecture series. But it will be again only 2 hours. So I'm not sure whether we'll be able to take all the presentations during that 2 hours. So let's discuss with us. So I told the representative to discuss with all students and get back to me on that. So please put forward your suggestions as well, how I can take the group presentations, especially of these online groups, right? I hope you all also have teams. Do you have groups already?
Yeah, madam, we have a team, like it's like a hybrid team.
Sorry?
Few from physics, it's like a hybrid team, like
Uh-huh.
it's 2 from our team. We have 2 from physical class and 4 from online
Okay,
students.
okay. So in that case, when we are scheduling the presentations, let me know how we could do it, like how, like the timing and all of that. Whether you are comfortable to do it during the class time or any other time. Because presentation, of course, I can even take separately in at your convenient time. So let me know. Okay. That
Okay,
will
madam.
indeed will be, now I will set up a date for the report submission. So the presentation will follow after that, after the report submission. Right? So that will be towards the end of February month. Okay.
Okay.
So let me know how we can schedule the presentations. Okay.
Okay, madam.
Okay. Okay, then thank you very much. Now I told the representative, what's her name, Pavani, to create a common sort of a group list and send me. So please send your group list also to her. I told her to compile a document like a Word document or something, including all the groups, members and the registration number, the group list. So please give your information to also to her and compile that list and send me one list of all the group members. Okay.
Okay, madam.
Thank you so much for joining in.
Okay.
I'll see you in the next session.
Okay, thank you, madam.
I think next week is a holiday. Please check your schedule. In
Yeah.
that case, I'll see you the following week.
Okay, thank you, madam.
Okay, bye.